Okay, so the standard that we are going to talk about today is IS 20 government grant. Okay, now what is government grant and how do we treat that? Let's understand. Government grants are assistance by government in form of transfer of resources in return for compliance with certain conditions related to the operating activities. So government grant is basically the assistance by the government. The government is providing you with some kind of help, with some kind of assistance, providing the company some kind of assistance in return for compliance with certain conditions related to operating activities. But but they are asking you in return that you need to follow the conditions. You need to comply with the conditions that we will told you. Okay. So that is what government grant is. So government is providing you assistance. Government is helping the company, but in return they want company to meet certain conditions. Okay. What is government assistance basically? Government assistance, which okay, now government assistance which can't be reasonably valued or transaction which can't be distinguished from normal trading transactions are excluded from government grant. Very, very important point. I told you that government is giving you some kind of assistance, right? In return of the company meeting certain conditions. Now, if that assistance, you cannot value that, like you cannot distinguish that transaction, the assistance that government has provided you. Like, for example, you don't know that how much worth that assistance is, then you will not consider it as government grant. Like, for example, I gave you an example, free technical or marketing advice. If the government give you some kind of technical advice, marketing advice, so we cannot value that, right? I cannot say that, oh, government give us the marketing advice and its value is $1,000. Or the government
Mhm.
gave me free technical advice and its value is $500, right? And I cannot distinguish that from the normal trading transaction as well, right? It cannot be
Mhm.
valued. So such a thing will be excluded from the government grant. Okay, clear?
Yeah.
Government loan below market interest is accounted for as government grant. Interest benefit will be accounted for using deferred income method. We will do what deferred income method is, but here you just need to know that if government is giving you the loan below the market interest, then that is also a government grant. Like for example, normally the government gives you the loan rate. The normal market rate of loan is 10%. Okay, so whatever the loan you will took out from the bank, you have to pay the 10%. But government is giving you a loan where you have to pay, let's say, 7%. So 3% you get benefit, right? So that benefit is also your government grant. Okay, clear?
Mhm.
So what three things so far we have learned? First thing is that government is assisting us, helping us with something. In return, they are asking us to follow certain conditions. Second thing, the assistance that we cannot value, we will not account for it. So basically, what we can value, only that we will account for. Third thing is that government loan below market interest rate is also the government grant. Okay. Now comes the main part, the calculation part. How do we treat the government grant? Okay, so for the treatment you need to know what type of the grant is. Okay, the grant is of two types. First one is capital grant and second one is a revenue grant. So it depends upon which type of grant is, we will treat that accordingly. Okay, now let's start with the capital grant first and let's see what the accounting treatment of that grant is. And then we will talk about the revenue grant and let's see what the accounting treatment of that grant is. Now, what is the capital grant? You can clearly see here, I have written down in front of that, grant related to asset. So basically, government has assisted you in respect of some asset. Well, I can give you a very simple and easy explanation. Like, for example, let's say the government is saying that now we want to create an environmental friendly environment, okay, eco friendly environment where the CO2 emission is less, the pollution is less. We want to control that. So we are, like they are asking the company that if you purchase the non current assets that are, let's say, eco friendly, so we are going to help you with that. So this type of the grant will be known as capital grant. Got my point?
Yeah.
So
Yes.
government is helping you purchasing an asset, okay? And obviously, what is their conditions? There, if you have purchased an asset, let's say the government paid you some amount so that you could purchase the asset, and the life of the asset is 5 years. So it means you have to use that asset for 5 years, right? That is why the
Mhm.
government helped you that use that eco-friendly asset for the 5 years. So the condition is what? Usage of asset. Use the asset for its complete life. If the government do not put certain conditions, then the company can, just take the grant from the government and just resell the asset, right? They can do that. Like they can do this false thing as well. So what conditions is for the company to use the asset? So government is helping the company purchasing some asset and company have to use that. Clear? Capital grant is clear?
Yes.
So the grant related to the asset is known as capital grant. It can be treated in two ways. There are two accounting treatments of capital grant. First one is net asset method. Second one is deferred income method. Now first let's talk about net asset method and do an example and then deferred income method. What is net asset method? Asset initially recorded at cost less grant. Initially you will record the asset at cost less grant. Let's say for example the cost of asset was 1000 and government gave you the grant of 30,000. So initially you how at which value you will record the asset? 1000 minus 300, 700. Okay. First thing. Income is recognized through reduced depreciation expense over life of asset. Now the reduced depreciation expense, you will recognize the income in form of that. Now what does that mean? How does this thing works? Let's understand this with an example because the example will help you understanding the things. Okay. Now let's start. Okay, so first method is net asset method. So first we are going to do net asset method and then we are going to do deferred income method. So I'm going to write down here net asset method. Now let me read the question. An entity opens a new factory and receives a government grant of 15,000 in respect of a capital equipment costing 100,000. So an organization has opened a new factory and government have assisted them with respect of a capital equipment. Capital equipment means non-current asset and the cost of equipment was 100,000. Okay. So initially, at what value will you record the asset? Initially, at what value? The value of the asset is going to be cost
Mm.
less grant. So the asset value initially is going to be 100,000
Minus 15.
minus 15,000. So that is what the value of the asset is going to be 85,000. Okay. Then it depreciates all plant and machinery at 20% per annum straight line. So obviously, if you purchase an asset, you have to depreciate that as well, right? And the
Yeah.
depreciation is 20% per annum straight line, which means every year you are depreciating it for 20%. Straight line means every year it is going to remain the same. So I can say
Mhm.
that 20% straight line means the life of asset is 5 years, right? Because if every
Mhm.
year you are reducing it by 20%, so at the end of the 5 years, it would be like 100% depreciation, right? So the life of asset is 5 years. Any question till this point?
No, it's very understandable.
Okay. Now, at the end of first year, at the end of first year, how will you record this? How will you record this? So basically, what was the initial value of the asset? The value was 85,000, right? So in
Yeah.
SOFT, you are going to record the asset at carrying value. So the carrying value of the asset is going to be cost less depreciation, right? And in
Mhm.
SOTL, you will record the
The
depreciation. Now
cost.
look, what would be the depreciation?
Mhm.
The cost divided by useful life, right?
Mhm.
85,000 divided by 5, or you can simply say 85,000 multiplied by 20%, both will give you the same answer. So 85,000 times 5 will give you 17,000. 17,000 will be the depreciation charge for SOPL. Depreciation charge in SOPL that you are going to deduct from SOPL. Is this part clear?
Yeah.
Even if you do 85,000 times 20%, you will get the same answer, or you can do 85,000 divided by 5, you will get the same answer because it is straight line. So every year, same amount of
Same amount.
depreciation. So it means
Mhm.
life is 5 years. Now, what is going to be the carrying value of asset? Initial value was 85,000, and the first year depreciation was 17,000. We just calculated that. So the asset will be recorded at 68,000. Okay. That is the
Mhm.
first adjustment that you do. Is this part clear?
Yeah.
So that is uh, according to the net asset method. So the asset would be recorded as 68,000, and 17,000 is what you will take to the statement of profit. And in this way you are going to do the things like when the second year will come, you will deduct like more 17,000 more, then 17,000, then 17,000, and at the end of the life the asset would be at zero, and in this way everything will work. Clear?
Mm-hmm.
Okay, now let's start the other method, deferred income method. Now that is very important. This method is what you need to understand. The second method that I'm going to talk about, you need to set up a deferred income balance, recognize income on systematic basis using life of asset. First thing, you have to set up a deferred income balance. Now, what is that? I will explain it to you. Then you will recognize income over the life of asset. Like you are going to recognize the income is what? The grant that you are getting, right? So you are going to recognize
Mm-hmm.
that on yearly basis. And the third and most important point, that in deferred income, the deferred income balance is split it into non-current liability and current liability. Now, how does all this work? This is what I'm going to explain to you. So this is very important. Understand this point very carefully. So deferred income method. Now in the net asset method, we were doing what? We were deducting the uh, government grant from the cost of asset, right? And initially recording the asset at that value. Here, we are not going to do that. We are going to treat them separately. So how we will treat them separately, let's understand. So here I am going to write what we will take to the statement of financial position, and here I will write what we will take to the statement of profit or loss. Now the first very important point, in the statement of financial position, I will record the non-current asset, right? And I will record the non-current asset at carrying value. So at the end of the first year now, what was the cost of asset? 100,000, right?
Mm-hmm.
And the useful life is 5 years. So what is the depreciation charge? 20,000. Here, this is deferred income method, not the net asset method where you are like deducting the government grant from the asset and recording the asset at that value. No, here
Mm-hmm.
you are treating the asset separately, grant separately. So the asset cost was 100,000 and the life was 5 years. So depreciation per year is going to be 20,000. So I will just put depreciation of 20,000 here. Clear?
Mm-hmm.
And what would be the carrying value of asset? 100,000
80,000.
minus 20,000,
Mm-hmm.
80,000.
Mm-hmm.
Let me just write it like this, that 100,000 minus 20,000, 80,000. Is this first part clear?
Yeah.
Now, how to treat the grant? Well, that is really, really important. This is what you need to understand. The first point that was mentioned here, that set up a deferred income balance. What do you mean by deferred income balance? That is really crucial. This is what you need to understand. Now look, the government is supporting you, right? The government is supporting you. Government is giving you the grant, but is the grant like free? Like you don't need to do anything, or you have to do something if the government is giving you the grant. You have to comply with the conditions of the government, right? The government has given you the grant, and they are in return expecting that you will comply with the certain conditions. And I told you that if government is giving you an asset, if government is supporting you with respect of an asset, so it means you have to use the asset over the complete period. Okay, you have to use the asset over the complete period. Now, what are you going to do? You are going to say that, okay, 15,000 is what the government is giving me the grant. Okay. And what is the point mentioned here? You recognize the income on systematic basis using life of asset. That you are going to recognize this grant as income, but on systematic basis over the life of
Over
asset. Like
5 years.
every year, yes, over 5 years. So you are
Mm-hmm.
going to divide this with five. So it means that every year you are going to do what? you are going to record the income of 3000 in the
Mm-hmm.
SOPL. Okay. So that income that you are going to recognize will be known as grant income. So it means that at the end of first year, what your grant income is going to be?
3,000.
3000. Because it is your
Mm-hmm.
income, so you are going to add that. Okay. Depreciation we have to deduct. That is why I have written bracket. And the grant income is 3000. Now, okay, out of 15,000, 3,000 you have taken to the SOPL. Very well. Okay, we got that point. Now, what about the remaining 12,000? How will you record that? Out of 15,000, you just took the 3,000 to the SOPL of the first year, right? Right? What about that
It's like
12,000?
long-term liability.
Liability, deferred income liability, that it is your income, but it is your delayed income. So you can treat that like a liability, that okay, if I meet that condition, I will record the grant income. Like if for
Mm-hmm.
example, for the complete first year I used the asset, so 3000 I took that to the SOPL. So remaining 12,000 is my liability right now. Next year, if I follow the conditions, 3000 more I will take to the next year's PNL. And similarly, I will do that, right? Now, at the end of the first year, all these workings that we are doing, it is at the end of the first year, okay? Now, the 12,000, it is your deferred income liability, okay? It is
Mm-hmm.
your deferred income liability. And he has mentioned that in the deferred income method, you have to divide that liability in non-current and current liability section. Now, how will you going to do that? Now, what is the current liability? What is the current liability? The liability within 12 months, right? And what is the non-current liability? That will be settled after 12 months. Now, out
Mm-hmm.
of this 12,000, how much of the liability is going to be reduced in a year?
3,000 more.
Yes,
Like
3,000 more. Yes. And how much is going to be left at the end of the first year? 9,000.
9.
Yes. So it means that in the SOFP, in non-current liability section, you are going to record the deferred income of 9,000,
Mm-hmm.
and in current liability, you are going to record the deferred income of 3,000. So these workings
Okay,
that we are doing
understand.
are at the end of the first year. Okay.
Mm-hmm. Yeah,
Got
understand. Because 3,000 we will receive in less than 12 months and
Yes.
9,000 in more than 12 months.
Okay.
Mhm.
Now,
Yes,
when the
understand.
next year will come, second year, so in 3,000, you are going to take more in the PNL, and then how much balance would be left? Okay, let's say it was end of second year. At the end of second year, 9,000 would be there. 3,000, uh, you would take that to the SOPL,
Yeah.
and remaining you
Mm-hmm.
will divide that amongst the non-current and current liability, and so on. So at the end of the 5 years, your liability will also will go to the zero, and your asset will also go to the zero. And you had
Mm-hmm.
recorded the income on yearly basis. Got my point?
Yeah.
Okay. Now here we you we read a one thing, that in net asset method, income is recognized through reduced depreciation expense. That the grant income is recognized through reduced depreciation expense. Now, what does this mean? Look, in the deferred income method, what was your depreciation? 20,000, right? Minus 20,000. And grant income was 30,000. So, if let's say the deferred income method was used, the depreciation would have been 20,000, right? But when you use net asset method, what was your depreciation? 17,000. So your depreciation reduced by 3,000 in net asset method. So this is what is meant by the second point, that the income is recognized in the form of reduced expense in the net asset method. So that
One
is
more
your
time. One more time. One more time.
okay.
One more time.
Look,
Last sentence
in
because
this
I.
in net asset method, what was written here? Income is recognized through reduced depreciation expense. Like grant income is recognized through reduced
Yeah.
depreciation expense. Now look
Mhm.
here, in the deferred income method, what was your depreciation expense? 20,000. And if let's say you were not deducting the grant from the initial value of the asset, your depreciation charge would have been 20,000, right? But
Mhm.
in the net asset method, because you deducted grant in advance, what was your depreciation charge? 17,000. So your
Mhm.
depreciation expense is less than 3,000 in net asset method. So it means that
Mm-hmm.
this income was recorded in the form of the reduced expense.
Mm-hmm.
So this is what the point meant.
Yeah, understand. Mm-hmm. Thank you.
So that is the capital grant. Clear?
Yeah.
Okay. Now let's move on to the revenue grant. The revenue grant is very simple. The grant that relates to the income. Okay, grants that relate to the income. Now, what is the treatment of that grant? One treatment is deferred income method that we have already discussed. Now, let's understand the second one with an example so that it would be clear. Okay, deduction from related expense. Okay, now the revenue grant is where government has given you the grant for a certain thing, for a certain expense. Okay, the government has given you an income for a certain expense to reduce a certain expense. The very easy example I can give you to is that the government wants that your employees get trained according to the like the latest technology. So they have given you the support in the training cost. Let's say your training cost was 20,000, government paid 5,000 of that. Okay. Government paid 5,000 of that. And against that, the government is saying train your employees for 3 years. So that is their condition. So government
Mm-hmm.
gave you the grant for a specific expense. Okay. Or to help you with a specific expense. This is known as revenue grant. Okay. Now, there are two ways in which revenue grant can be treated. The first one is deduction from related expense. Whatever the expense for which the grant was given, deduct the grant from there. And second one is deferred income method. Okay, now let's understand this with an example. Let's understand this with an example. Now here, the example is here. An entity is given 300,000 to keep staff employees within a deprived area. The entity must not make redundancies for next 3 years. So government have given an organization 300,000. Why? Just to keep their employees there. The company is facing some problems. They are unable to pay like salaries, or they want to close like certain division, and they want to redundant the employee. You know what redundancy mean, right? Do, do you have any idea
Understand.
about redundancy?
When you fire somebody.
No, redundancy is basically like, let's say there are three divisions of the company. Now, if the company is planning to close one division, so it means obviously all the employees there have to be like, you have to fire them, right? Or they have to leave the job. So that is
Mhm.
redundancy. Like you are closing a division, and if you are closing a division, obviously you have the
You're
employees have to
firing
leave.
the people
Yes,
basically.
yes, yes. So
Mm-hmm.
the employees have to leave. Now the government
Okay.
is saying don't do that. Like the country is facing already the employment issues. So we are requesting you not to do that. If you are like facing problems paying them salaries, we are going to give you 300,000. But against that, what is your condition? But against that, the condition is that you are going to keep the employees for 3 years. Okay. You are going to keep
Mm-hmm.
the employees for 3 years. Now, the first treatment that I told you was deduction from related expenses. Okay. Now let's say uh, uh, the in SOPL the related expense is administration cost. Okay, administration cost. The administration cost is, for example, let's assume the administration cost is, let's say, 600,000. Okay, so government is now facing challenges. The salaries are recorded, let's say, in the administration cost. Government is facing challenges of like paying the salaries of the employee. So the company is facing the challenges. So the government is saying, okay, no problem. Let us give you the grant. So the grant is given. So just deduct this 300,000 from here. So in SOPL, you will record how much amount? 300,000. That is the first treatment. Similarly, let's say the government give you grant to train the employees, or let's say the training cost was, let's say, 100,000, and government gave you 20,000 for that. So deduct that 20,000 and record just 80,000 as your expense in SOPL. This grant relates to the income statement. Okay, like related to the income means that basically for the majority of the time SOPL expenses. Okay, so just deduct this grant from the relevant expense. That is the first treatment, deduction from related expense. Is this clear?
Yeah.
Okay. And the second one is deferred income method that we have already done. So what are you going to do basically? The total grant is 300,000, right? And how many years you need to keep employees? 3 years.
3 years.
So every year you are going to take 100,000 in the SOPL, statement
Mm-hmm.
of profit or loss. Every year you are going to take 100,000 to the SOPL, and remaining 200,000. Like for example, at the end of the first year, 100,000 is taken to the SOPL. How much is left? 200,000 is left. Out of
Yeah,
that, 100
100 will be
be
definite,
uh,
long term and short term.
yes,
Mm-hmm.
100,000 will be recorded as deferred income in current liability, SOF, SOFP, and 100,000 would be recorded as deferred income in non-current
Mm-hmm.
liability, SOFP. So here you do make an adjustment in your balance sheet as well, okay?
Mm-hmm.
And this one that you take, it is known as grant income, okay? Grant income. So this is how the deferred income method works. Clear?
Yeah, it's very clear. You explained it good. So,
Okay. So now it just give me okay. So now are these two methods clear? Both of them? Any question you want to ask
yes,
in?
now it's
Okay.
clear.
Okay. Now in form of double entries, let's discuss the double entries as well. Well, double entries, I don't think so. It won't be tested, but anyways, you should have an idea about the double entries as well. Okay. Now
Mm-hmm.
here in the deferred income method, the deferred income method that we discussed. Wait a second. What will be the double entry for the grant? How will you record it? Double entry. How much grant did you receive? 15,000, right? So you will debit cash by 15,000 because you receive 15,000 for government, right? And against that, you are setting up what? A deferred income liability. So you will credit deferred income liability of 15,000. Clear? Initial recording in terms
Mm-hmm.
of double entry. Then when 1 year will pass, you will take one of you will take like the in this example 5 years was the useful life of asset. You will take 3,000 into the P&L, right? What would be the double entry for that? Debit, you will do deferred income, and credit you will do grant income. Now this is very interesting. Now this is what you need to understand. Look, deferred income you did credit, and I tell you that it is kind of like your liability, right? You are setting up a liability balance. So after 1 year, your liability is reduced by 3,000, right? After 1 year, the liability is reduced by 3,000. So you will do what? Debit deferred income 3,000. And that 3,000 you are taking to this SOPL. So you credit 3,000 a grant income. When you are crediting something in SOPL, it means you are adding that to the SOPL, right? And here
Mm-hmm.
you are debiting the liability. Okay, you are debiting the liability. So you're reducing the liability basically. Clear? The double entry is clear.
Mm-hmm.
So that is the double
Yeah.
entry that you are going to make. Clear? For the
Mm-hmm.
deferred income. Okay, so now the last thing in this standard is a repayment of grant. Okay, now let's say, for example, the government supported you, government gave you the grant, but you were like unable to meet the conditions, then obviously you have to repay that. Okay, now how to adjust that repayments in our books? Let's understand that. If conditions are breached, grant need to be repaid. If you do not comply with the conditions of the government, you have to repay the grant. If net asset method was used, increase the carrying value of asset as if no grant was there, and set up liability for grant repayment. Very important point. Now, if you are unable to meet the conditions of the government, you have to repay the grant. And if let's say you were using net asset method to record the grant, then you will increase the value of asset, considering like if there was no grant. If no grant was there, what the value of asset would have been? You need to make the adjustment like that. Okay, and you need to set up the liability for grant repayment. Now let's understand this first, and then we will go to the deferred income method. Okay, So now
Mm-hmm.
you need to repay the grant. Okay. Now where do I write it? Where do I write that? Where do I write that? You got this double entry, right? This
Yeah.
double entry. Can you take the picture so that I could raise that and do an
Yeah. Yeah.
adjustment for repayment? Just take the picture so you know about the double entry.
Mm-hmm.
Okay. So have you taken the screenshot picture?
Yes.
Okay. Okay. Now, now we are talking about the repayment. Okay, repayment. How to do the repayment? So if you are using net asset method, how does the repayment work? Let's first discuss that because the other one is not that much difficult. So we can adjust that. So repayment, if net asset method was used. So if net asset method was used, first we will see and we have to make the repayment. We have to see what the value of asset would have been as if there was no grant. Okay. So now here in this situation, uh, look, wait a second. So I will write if grant was there, if grant, and I will write if no grant, then I will tell you how to make an adjustment. Okay. Now in the net asset method, the grant was there. So at what value did we record the non-current asset? At 85,000 initially, right?
Mm-hmm.
So asset was recorded as 85,000. And if there was no grant, then what would have been the value of the asset?
100.
100,000. Okay. So the useful life we know is 5 years. Okay, so first year passed, everything's working very well. You are following the conditions. You charge the depreciation of 17,000
Mm-hmm.
and the carrying value at the end of the first year 68,000. Very good, no problem at all. Okay, all good. Now, after 1 year passed, the entity, the organization, they did not follow the conditions. They do not follow the conditions. So they need to do what? They need to repay the grant, right? Because they are not following the condition for the first year. They followed
Mm-hmm.
that. Now they are not following that. They are not complying with that. So now they have to repay the grant. Now, how to adjust that repayment? That is what I'm going to tell you. Here in the notes, it is clearly written you need to increase the value of asset considering that if the grant was not there, what the value of asset would have been and set up the liability for grant repayment. Okay. So liability part is very simple. Liability setting up, means that you will credit the liability, right? You will credit a liability that uh, credit liability by 15,000 because you have to now repay this grant, right? Right. So this is
Mm-hmm.
what you need to do in the credit side. Very simple that you will set up the liability that we have to repay the grant. So that is our liability. Now, how to adjust the other thing is very important. Now, if no grant was there, what the depreciation would have been in
20,000.
20,000? Yes. So carrying value would have been 80,000, right?
Mm-hmm.
Now, in the second year, in the second year, the depreciation charge, let's say I will do one more thing. Okay, now the next part is what you need to understand because this part is very crucial. Debit asset and debit depreciation. Okay. Look, if no grant would have been there, the asset value would have been 80,000 at the end of first year, right? If no grant was there, the asset value would have been 80,000 at the end of the first year. Am I clear with that? If grant
Mm-hmm.
is there, this was the value of asset at the end of year one. Now, the problem is that in the second year, you do not comply with the conditions. So you have to tell that by the end of second year, what? by how much should you increase the value of asset and depreciation? This is what you need to tell. Now, the next thing that I am going to do is really, really, really important. Okay, this is what you need to understand. Look, for the first year, let's first see for the first year. For the first year, what was the depreciation expense that you charged when the grant was there? 17,000, am I right?
Mm-hmm.
And for the second year, how much did you charge? 20,000. So it means that depreciation expense you have to increase by 3,000. That is the adjustment for the previous year. That you will increase the depreciation by 3,000, and that is the adjustment for previous year. Am I clear?
Okay.
Okay. Similarly, in, in the second year, if you would have charged the 17,000 depreciation, let's say, what would have been the value of the asset? 68,000 minus 17,000. What would be the value of the asset?
51.
Yes, 51. Now understand this, the next point that I am going to make. The thing
Mm-hmm.
is, okay, yeah, now actually the thing is space is less. Wait a second, let me do one thing. So let's say second year depreciation 17,000 here, and this would have been 51,000, and depreciation 20,000 here. So this would have been 60,000. End of year two. Actually, the space is really less. That is the problem. End of year two. End of year two. Credit, you will do liability by 15,000. That is very simple. That you need to repay the grant. So record a liability of
Mm-hmm.
15,000. Now, what will be on the debit side? By how much you will increase the asset? By how much you are going to increase the asset? 51,000 to 60,000. 9,000,
Mm-hmm.
right? So you will increase the asset by 9,000. And by how much will you increase the depreciation with? By how much will you increase the depreciation?
6,000.
6,000. Yes. Why 6,000? Because 3,000 per year. So for 2 year, it is going to be 6,000. So that is the adjustment of a repayment. Let me put it down in the bracket. So now the adjustment is set up by keeping in the mind if no grant was there, what would have happened? Right? If no grant was there, the asset should have been at 60,000 at the end of the 2 year. Am I right? But because of the grant, it was in 51,000. So you increase the asset by 9,000. And every year, 3,000 depreciation expense was reduced. But now we are considering there was no grant. So it means we have to increase the expense by the amount as well. So for 1 year, it was 3,000. For 2 year, it would be 6,000. So that is the adjustment.
Mm-hmm.
Is it
Okay.
clear?
Yeah.
Then if deferred income method was used, if let's say deferred income method was used, then the remaining grant would be repaid. Whatever is the remaining, you have to repay that, and already released grant would be reversed. Now that is very important. In the deferred income method, every year you were taking something to the grant, right? Every year you were
Mm-hmm.
taking something. So now let's see how to adjust that. This adjustment is very simple. So I'm going to write down a repayment revenue grant. So let's consider the first example. Okay, in both situations, the revenue grant remains the same, but let's consider the first example now. Okay. So in this first example, we only consider first year. So how much did you take to the statement of profit or loss? 3,000. Am I right?
Mm-hmm.
And how much of the grant is left? 12,000, right? So you will do what? Basically, it is very simple. You will credit cash, or basically you can like credit. Wait a second. Yes. You can credit liability as well, repayment liability. Credit cash or liability, whatever the amount is. You can credit liability. How much grant you need to repay? Same 15,000. How much did you already took to the statement of profit or loss? 3,000. So what double entry would you made? Credit, you did credit, right? So you will debit that, debit SOPL by 3,000. So it means you are reversing the statement of profit or loss, okay? And the deferred income balance that was there on the credit side, you will just debit that. Debit deferred income 12,000. Now, if you look at the double entry that I said that take the screenshot of that, let me write down that double entry here as well. Let me write it down here. So initial measurement would have been debit cash 15,000, credit deferred income by 15,000. So this was your liability. Now, after in 1 year times, you would have done what? Debit deferred income, like you would have reduced the
Mm-hmm.
liability by 3,000. You reduce the liability by 3,000 and you credited the grant income, which means you recognize 3,000 in the SOPL. 3,000 in the SOPL, right? SOPL. Now, whatever you already recognize, whatever you already recognize, you did what? You reversed that. You debited it SOPL. Because you took that to the statement of profit or loss. So now you are going to reverse that, like you take that into the statement of profit or loss previous year. But in the second year, you found out that you are not meeting the conditions. So in this year, you are going to charge that as an expense, which means you are reversing that. Is this first part clear?
Mm-hmm.
Now the
Yeah.
remaining balance that was there, remove that balance, 12,000, and set up a liability for repayment of 15,000. Clear?
Mm-hmm.
If, for example, let's say 2 years would have been passed, and in third year you did this stuff. In third year you did this stuff. So if the 2 years would have been passed, how much you would have taken to the statement of profit or loss? 6,000, and remaining 9,000 was in your deferred income balance, right? So 6,000 you will debit the statement of profit or loss, and by 9,000 you will debit the deferred income, and the liability for the repayment you will set in a similar way. So in this way, the grant repayment is done. So that is your IS 20 government grant.